because it's tax saving season, and this is around the time when a lot of people start remembering, oh, you know what, I want to reduce the amount of tax outgo that I have, and so they end up making their tax saving investments towards the end of the year, even though they should ideally be making it earlier. Having said that, we said let's talk about ELSS, which is a popular choice, equity linked savings schemes. What are they about, and what do people need to bear in mind? What are the key traits?
So it's one of the simplest product out there, Alex. I don't think it requires too much explanation. I would rather actually say that this is one category which is so large in the Indian mutual fund industry and yet so small. So if I look at the category AUM today, it's almost 1.5 lakh crore worth of assets being managed under ELSS category out of roughly about 20 lakh crore of retail assets in the industry that gets managed. So industry is much larger because of institutional money. But if you look at retail money, it's about 21 lakh crore, out of which about 1.5 lakh crores is ELSS. So it's very large, but yet so small compared to the, almost every individual investor has a need of tax saving. Like, you can't escape taxes if you are earning income in the country today. And if you are not able to escape it, then the sheer amount of population that we have in the country of 7 crore taxpayers and growing every year, this category is actually quite small, and it's at the same time very, very simple. It's one of the most diversified ways to invest. You can actually buy an ELSS fund. It gives you exposure across all market caps, across all sectors, no biases from the fund manager. The fund manager takes a very long-term view towards managing your money, because when you come in, its money is locked in for 3 years. That means the fund manager has enough time to deploy money in a very thoughtful manner, manage that money. And because investors are not going to have a lot of redemption pressures based on market situations, both the parties give enough time to the whole thing, and returns actually have been compounding quite well. So if you compare the typical performance of ELSS versus FlexiCap, you would typically see that ELSS categories actually mimic or better off the FlexiCap returns over long periods of time. If you look at any period of 3 year, 5 year, 7 year, 10 year, the returns have been in the range of 10 to 15% annual, and that's actually almost 50 to 100% more than what people can typically get in a PPF or a bank deposit, tax-in bank deposit, and other products. So the greatest kind of aspect of ELSS as a category is very simple to understand. A diversified mutual fund goes anywhere, no sector biases, long-term investment approach, shortest lock-in period of 3 years. I can go on the advantages. It's one of the best ways to invest for tax saving.
I'm going to ask you how it stacks up against the others. And here, this is actually an instrument that sits in the ATC section, which allows you for various deductions from your taxable income, right? So I'm guessing, Santosh, for a lot of our salaried viewers, they have to first calculate how much goes towards the employee provident fund, deduct that from 1.5 lakhs, whatever gets left over is what they have to account for. ELSS is one of the options, and I wanted you to compare them with the others. So a lot of the popular ones are, for example, the public provident fund. You can increase your allocation to the provident fund through a VPF mode. You have various others as well, right? You have FDs as well that you can invest in. How does it stack up to the other investments?
From a stacking up standpoint, Alex, there are like two critical areas we should look at. One is the returns, of course, and we spoke about it. Typically, PPF, EPF, the returns are in the range of 7 to 8.5%, and the returns actually get decided by the Labor Ministry or Ministry of Finance every year. You get to know in towards April, May, what is the returns for the last year. So basically, returns have been like more or less 7 to 8.5% range for long periods of time. So you have a predictability towards what you will get once you invest in EPF or PPF and VPF for that matter. And ELSS as a category has given like 10 to 15% return over 3, 5, 7 year, 10 year periods. So the compounding of even a 1% return CAGR over 5 to 7 years can be significant amount. Imagine what a differential of 2 to 7% CAGR over 5 to 7 year period can do to your wealth creation. So it's enormous by any stretch of imagination. But what you should look at is it's not a guaranteed return product. unlike a EPF and VPF or a PPF for that matter. So you should be coming along only when you are having a risk appetite of ups and downs and having a long-term view towards putting that money. However, one of the very interesting aspect that we should look at ELSS with is the shortest lock-in period. Now, what sometimes personally I have failed to understand is when you are putting your money in EPF or a VPF or a PPF for that matter, the typical lock-in period is 15 years. And you are knowing that by locking my money for such a long period of time, 15 years, I'm only going to get 8%, 7.5%, 7% kind of return, versus by locking my money just for 3 to 5 years, because 3 years is a mandatory lock-in period. If I assume the lock-in is 5 to 7 year period, the returns are much, much more. So it's like, you are locking your money for a long period of time and getting a worse off deal in terms of returns, compared to locking your money for smaller amounts of time and getting a better deal on returns. So it's like, the weight always tilts towards ELSS in terms of convenience, in terms of shorter lock-in period, and of course returns. On your point about how one should go and calculate how much money should go towards ELSS, so there is a ATC cap of 1.5 lakh rupees. Now salaried individuals get EPF, and they can decide how much money they should be putting in after adjusting for the EPF, and sometimes even tax the term plan life insurance premiums that people are supposed to pay for themselves. So if you take that out, it becomes a good healthy chunk of at least 50 to 70 to 80K or even 1 lakh rupees for many people, and people should maximize that thing for sure. But for non-salaried audiences, which is a large portion in the country today, in my opinion, it's a completely green field, right? So they don't have EPF. The people who are not working under any kind of payroll department or under employees, they don't have any kind of social security for themselves in the form of EPF. They should actually be looking at maximizing the entire 1.5 lakh rupees after paying off their term life insurance premiums towards ELSS. And I would actually go one step further and say that if you have a risk appetite to invest in equity investments for long periods of time, you should actually look at starting SIPs of at least 8 to 10,000 rupees. Your first 8 to 10,000 rupees monthly SIPs should be going to a ELSS. It gives you two advantages. It saves you tax automatically, so you don't have to run around in the month of March to gather extra cash from somewhere and put that money to tax saving. And secondly, it actually gives you healthy discipline of putting every month in form of SIPs and create a long-term wealth creation plan for yourself.
You've already answered the mode of investment. There are some that worry that each SIP gets locked in for a period of 3 years. But having said that, you are already advising people to look at it as a 5-year investment rather than a 3-year investment. So I think that kind of covers that aspect to it. I do want to ask you, and this is the last question, unfortunately, because we're running out of time, Santosh, but how do you choose the right ELSS scheme? Because there are so many options available to you.
Yeah, so typically ELSS funds are like diversified flexi cap funds, go anywhere kind of thing. So most of the funds are managed as diversified equity funds, so to speak, Alex. The kind of criteria should go as you look for any other fund, not just look for past performance of last 1 year or 3 year returns. Look for consistency of performance. And how the fund actually performs in downside or down markets as well. So at ET Money, we believe there is two critical aspects to look at every fund to evaluate. One is consistency of returns, another downside protection. We provide that on the app as well, so people can actually go and look at. Just prioritize your returns, fund selection based on these two parameters, and you will do good for yourself. Another aspect you can also look for measuring consistency is rolling returns for the category. So if the rolling returns of a fund are good, like take any 3-year period, any 5-year period, any 7-year period, if the returns are looking similar for across all the 3 periods, then you would know the fund manager actually doing a pretty good job in consistency of returns, and you can go for that kind of fund.
Fantastic. I think it's been an insightful conversation, and we've had a bonus conversation also, which I think is a very, very good way to spend our evening. Thank you so much, Santosh, for taking the time.
Thanks, Alex.